Hey everyone, after generating multi-fold returns during COVID bull rally, Indian chemical companies have corrected significantly over the last 2-3 years. Honestly, it has left every investor confused because everyone was talking about China plus one theme and rise of Indian chemical industry. In fact, last year McKinsey published a report titled India the Next Chemical Manufacturing Hub, where it mentioned three key factors that would make India the next chemical manufacturing hub. First reason was rising domestic consumption, where India is expected to account for more than 20% of incremental global consumption of chemicals over the next 2 decades. Domestic demand is expected to rise from $170-180 billion in 2021 to nearly 850 to 1000 billion by 2040. Second factor was changing consumer preference. The growing demand for bio-friendly products globally could benefit India, as it is among the leading producer of many chemicals that are used in such products. Third, shifting supply chains. Triggered by the evolving geopolitical scenario and the trend to diversify from the existing core manufacturing market, firms are seeking to make their supply chain more resilient. With its strong value proposition, India could be a preferred destination. It was an excellent report where McKinsey benchmarked Indian chemical sector against the world, where India was leading in labor cost, workforce availability, construction cost, material cost, machinery cost, while lagging in domestic availability of feedstock and R&D talent. Then this report also discussed the winning themes in the chemical space. And I remember discussing it last year, so I don't want to cover it again. In case you want to read the report, I'll provide the link in the pinned comment. In today's video, I want to give you an overview of the latest update on the chemical sector and help you understand what went wrong in the growth thesis and share my viewpoint on whether the chemical sector has bottomed out or not. Finally, I'll quickly share a few key stocks to keep a close eye. But before we begin, a disclaimer that this video is only for education purpose. Kindly do your own research before investing your money. Alright, let's get started. So if you look at latest Q3 results of chemical companies, barring a few, majority of them have struggled in both revenue and profit growth. In fact, I was going through a research report that tracked 39 chemical companies, out of which majority of them have degrown on both revenue and profit side. Net, there is revenue degrowth of 7.4%, EBITDA degrowth of 37%, and PAT degrowth of 32.5%. So essentially, there are two key challenges that has resulted in underperformance of chemical stocks. First is Chinese dumping. Over the last few quarters, Chinese chemical companies have dumped chemicals in global market at a very low prices. It is due to slowdown in Chinese economy and probably trying to put pressure on competition. Second is muted demand and inventory destocking. Due to slowdown in Europe and US, the demand for chemicals has reduced. Moreover, companies were already sitting on high chemical inventory and that resulted in inventory destocking. So due to Chinese dumping combined with muted demand and inventory destocking, Indian chemical companies have faced slowdown in revenue growth as well as margin contraction. Due to margin contraction, operating deleverage kicked in and that resulted in degrowth in earnings. However, the latest update from management is inventory destocking situation is progressively reducing and seems to have normalized. Moreover, the Chinese dumping has also reduced. So going forward, the demand for chemicals should improve on account of inventory restocking. However, the margin would be decided by prices set by Chinese chemical company. So that would be a key area to watch out for. Overall, the recovery of chemical sector might take a couple of more quarters. Hoping for good days in chemical sector to return in later half of 2024, that is by Q2, Q3 of FY25. Currently, we are in Q4 of FY24, but we need to keep a close eye. Again, this is a high-level update. At the end of the day, stock price of each chemical company would depend upon their individual performance, future growth, and of course the valuation. So it is actually a good time to consider accumulating good chemical companies in a systematic manner. Again, no need to hurry. But next 3 to 6 months would be a good time frame to consider adding good quality chemical companies. Now, what are some of those top chemical companies to look out for? So try to identify specialty chemical companies that have less impact of Chinese competition or they have a leadership in the global market so that Chinese competition does not disrupt their business. What are those companies? Let's have a look. Friends, before we discuss further, let me clarify that initially I thought of providing all the key update of top chemical companies in this single video, but then realized that it would be a huge video. Plus, I won't be able to discuss in detail about the latest update of each of the key companies. So now I have decided to restrict this particular video with latest update on Indian chemical sector and cover the top names in this space to watch closely. Going forward, I'll try to do video with quick update on some of these top stocks. So first one is SRF. If you look at 5 years of chart, after generating nearly 4 to 5 times return, SRF share price has been consolidating for last 3 years. At current levels, company command a market cap of 76,000 crore and a P ratio of 51. P is still high due to operating deleverage, but company has a price to sale of just 5.7. That has corrected significantly from peak price to sale of 7.6. So that's the first stock to keep an eye. I've already done detailed video on SRF. Second is Clean Science. Clean Science had a blockbuster IPO in 2021, where its IPO price was around 900 rupee and company got listed at 98% premium. And then it kept on rising to touch highs of 2600. However, stock corrected around 50% for more than a year and now consolidating from last 1 year. At current levels, company command a market cap of around 14,000 crore, P ratio of 55 and price to sale of 17.8. Although valuations are still on higher side, but Clean Science is a high growth company with strong moat. So hoping for earning growth to come back on track. Again, I've discussed Clean Science business in detail. Third stock is Army Organics. Army also had its IPO in 2021 at rupees 610 and it doubled in no time and then corrected. However, stock has recovered but still trading below 3-year-old high. Currently, company commands a market cap of 4,200 crore, price to earning of 58, price to sale of 6. I really like this company in small cap chemical segment, worth keeping a close eye. Already discussed it a couple of times in detail. Next stock is Deepak Nitrite. Again, same story. After generating multi-pack returns during COVID, Deepak Nitrite has not generated any return in last 2.5 years. At current level, company command a market cap of 30,000 crore and a price to earning of 37. Deepak Nitrite has been investing significantly in building its capacity and nearly 2,000 crore worth of projects are to be commissioned by end of 2024. So due to Chinese competition and current investment, its margins have contracted significantly from COVID highs. However, the current investment should start paying over the period of time, worth keeping an eye. Now next two companies are from the fluorine chemistry space. First is Navin Fluorine. That has seen sharp correction from peak of 5,000 to currently at 3,000 rupee. That's nearly 40% correction. And now it is trading at levels of April 21. Again, same reason for correction. First, company growth has slowed down in last few quarters and second, its margins has contracted significantly, hence impacting its earning growth big time. And third reason is Navin Fluorine always commanded a premium valuation. At one point in time, its P touched levels of 85, but now it has corrected to around 50. Although valuations are still high considering the slowdown in growth and there is no immediate recovery expected. And that is also the reason why its share price has fallen significantly. Currently, Navin Fluorine commands a market cap of 15,300 crore and a P ratio of 52. Then second is Gujarat Fluoro Limited. Currently, Gujarat Fluoro is trading at around 3,300, which is similar to levels of July 22. Now, Gujarat Fluoro has seen green shoots of recovery and expect FY25 to be far better than FY24. Having said this, it may take a few quarters to come back. From FY26 onwards, the battery chemical should be the key growth driver. And that's where company is going to do major capex. At current level, Gujarat Fluoro command a market cap of 3,400 crore and P ratio of 51. So valuations are still rich, but growth potential is also very high, especially in the battery chemical space. Seventh stock in the list is Fine Organics. After touching high of 7,000 rupee in September 22, Fine Organics has fallen 4,200 and that's 40% correction from peak and now available at March 22 levels. The major reason for correction is due to sharp fall in both top line and bottom line. The key reason is global slowdown. So exports contribute around 68% in company's revenue in FY23 and that has fallen 49%. Management has mentioned that there is at least one more quarter of pain for US and Europe. Currently, Fine Organics command a market cap of 12,600 crore and a PE of 28. So valuation wise, it is looking attractive. Once US and Europe would recover, Fine Organics should do well. Next in the list is Galaxy Surfactant. After touching high of 3,400, its share price is corrected to 2,300 levels, which is same as March 21 level. That is 3 years ago. Currently, it commands a market cap of 8,200 crore and a P ratio of 26. Next is Rossari Biotech. After a blockbuster IPO in 2020 and 4 times growth, Rossari Biotech is down 50% and trading at similar levels of June 20. The biggest reason was super expensive valuation. It touched PE of 90 and from there, it is now at PE of 30. Interestingly, Rossari top line and bottom line have grown even during difficult phase. But since valuations were very high, its share price corrected. But today, it is available at very attractive valuation. I think risk rewards are now very much favorable. Then 10th stock is Tata Chemical. I did a video recently explaining the reason behind sharp jump in Tata Chemical share price due to speculation around Tata Sons IPO where Tata Chemical had around 3% holding. However, another news floated in the market saying Tata Sons not looking for IPO and Tata Chemical share price fell down. So this recent movement was mainly due to rumors. Moreover, from business perspective, the environment is not very conducive for Tata Chemical. The largest business is soda ash and its prices are continuously under pressure that has impacted Tata Chemical's financials. And management has clarified that this pain could last for a few months. Currently, it commands a market cap of around 27,000 crore and a price to earning of 15.5. It would command a lower valuation because its key business of soda ash, which is a basic chemical, and its price fluctuate based on supply and demand. The next stock is Sudarshan Chemical. After touching high of 767, it corrected to levels of 362, but it has recovered to current levels of more than 600. It is again one company that is holding its ground and doing well even in weak environment. Currently, it commands a market cap of 4,200 crore with a P/E ratio of 47, looking very promising. Apart from this, couple of more chemical stocks that are worth tracking that include Yasho Industry, market cap of 900 crore, P/E ratio of 34, and next is Finiotex Chemical, market cap of 4,000 crore, P/E ratio of 35, where ace investor Mr. Ashish Kacholia is also very bullish. Apart from this, there are a few agrochemical companies that are also looking very promising. Again, the challenge from them is again same, oversupply from China, destocking by global manufacturer. Moreover, there was one more factor that impacted agrochemical companies, which is below normal and erratic monsoon season. But FY25 is expected to be the year of recovery. So 14th stock is PI Industry. This is undoubtedly the strongest agrochemical company in India. On one side, while entire agrochemical sector is struggling, PI Industry revenues has jumped 17.6% year on year and net profits are up 27.5% year on year. That is the reason while on one side, other agrochemical stocks have tanked badly, PI Industry share price has not corrected. In fact, it has grown. PI Industry is ranked among top 3 custom synthesis manufacturers in the world with more than 800 scientists for R&D and 50 molecules. Although management has mentioned Q4 is going to remain challenging. Management has guided for 18 to 20% revenue growth for FY25 and EBITDA at 25 to 26%. Currently, it commands a market cap of 57,000 crore, price to earning of 36, worth considering in portfolio. Then 15th stock is Anupam Rasayan. Company launched its IPO in March 21 at around 555 and it doubled in quick time. However, currently trading at around 900. Although next couple of quarters are expected to be tepid. Company is sitting on around 580 crore worth of cash, which is sufficient for planning its capex that would drive the growth in next 2-3 years. Company intend to become debt-free in next 18 months. Currently, it commands a market cap of 10,000 crore, price to earning of 63. Again, worth keeping an eye. The next stock is Sumitomo Chemical. Its share price is corrected around 35% from its peak and now trading at nearly June 21 levels. Company is gearing up to launch several unique first-time registration in India after years of effort, which are expected to ramp up over the next few years. Currently, it commands a market cap of 17,000 crore and a PE of 52. Then 17th final stock is Dhanuka Agritech. In last 3 years, share price corrected from peak of 1,000 to 600 but again zoomed to 1250. However, there is around 15% correction in the counter. Company is hoping for double-digit growth in FY25 provided monsoon are better and also they are coming up with exciting products in coming quarter. Company command a market cap of around 4,300 crore and a P ratio of 18. Now, chemical sector has more than 50 listed companies and it gets very difficult to track them individually. So I might have missed a few of them, but I've tried to cover the key ones. Now, if you want to know which chemical companies I am personally bullish and own in my portfolio, you can explore my weekly video series where I shared my recent updated portfolio. My website details are in the pinned comment. Friends, please understand that chemicals are part of our day-to-day life. Right from clothes to detergent to food, cosmetic, machine, rubber, plastic, industrial usage, and the list goes on. And the good thing is, chemical sector operates on good margin. So chemical companies generate high return for the investor. As of today, we have two challenges. Global slowdown and inventory destocking that is already normalized. So that's a positive news. And second is Chinese dumping that needs to be tracked closely. I'm sure eventually that will also reduce because in the long run, it's not good for both China and India. And third good thing is that after nearly 2-3 years of correction and consolidation, the valuation of these chemical companies have become fair. That has created a good opportunity to consider them in a systematic manner. So this is it for this video. If you find it useful, do share it with your friends. I'll see you next video. Till then, take care.